Sorry for the delay. We'll get moving very fast. I think I may have already been introduced, but Stephenson Harwood, a partner at Stephenson Harwood in the finance team. Elias, have you introed yourself? Elias, we'll get into the intro. Elias, Mark, Ting, Kenneth, Tom. I'm going to ask you some kind of probing questions about your businesses anyway, so I think we can you can give some information there. What are we broadly talking about? Who's got money? Who wants money? Who's lending? Who's backing you? At what price? And the kind of structures that you're using or seeing or would possibly like to see. Linked with that, I think we've got kind of three main themes that we're going to touch upon. That is a diversity of capital providers. We've got three capital providers on the panel here. We're going to look at products and structures, and there's a huge variety of products and structures in the market right now. Each of the capital providers here using different structures, and I think we've got Mark representing asset managers, and obviously you'll have a view on the different structures and how suitable they are for the market as well. And the last one is ecosystem. So 10 years have passed. A lot of the same people are in the industry. There's just been a shift from the kind of traditional European banks to more advisory, more asset management, and more kind of non-traditional or funds. So let's delve right into the question, and this one's directed at the capital providers at the table. So Kenneth, Ting, and Elias. I guess with a focus on Asia, I know there's a different categorization of what Asia is, but can you give us a high-level intro into kind of the product offering you have, your client type, deal size, asset focus, and age? And linked with that, can you give us a kind of idea or an overview of your investment or lending strategy? Do you want to start, Elias?
So just a small correction. We are actually an asset manager ourselves. And so the way that we think of our business is we invest capital in shipping, both on the equity and on the debt side. On the equity side, it's under the brand name of Borealis Maritime, and the debt side, Australis Maritime. The question is quite relevant for both sides. Obviously, this is a business that we started over a decade ago using institutional capital, mainly coming from the US. However, much more recently, we also have raised significant capital from the region, actually from Singapore. And so the strategy, first of all, on the equity side, historically has been very, very opportunistic. So effectively finding distress in the shipping markets and making these investments from a point of view of asset recovery over time and an asset play. On the lending side, it has been very, very different, and effectively we obviously identified the opportunity that was also highlighted earlier today on the bank panel of banks becoming a bit more restrictive in terms of their mandate and in terms of what they can or want to finance. And so we stepped into the void and effectively went everywhere that the banks do not want to go. So countries that the bank do not want to finance, we're there. Shipping segments like offshore, as an example, that banks are a bit more apprehensive for understandable reasons, of course, we are there. Age groups, financing vessels over 15 and very often over 20 years old, again, we do it. So this is the business model. On the equity side, given where the shipping markets are today, there is no real distress opportunities, and so the strategy has shifted to one of more structured approach and investments, and so we're looking for more of a leasing type of strategy, and we have, again, significant amount of capital to deploy in the strategy. Interestingly enough, for this panel, with a particular focus on Asia, which incidentally we define as anything east of Suez. So this is us.
Thanks very much. Kenneth, can you?
Sure. Thank you, Jeffrey. Thank you, Kevin, Andrew. It's a I've got this very unreal feeling because it's the first time I speak at Marine Money Conference, though not as a critical banker. So after 33 years in the bank, starting this April, I've started this ship leasing company together with my partner Sabrina Chow, who is now the immediate past president of BIMCO. So starting with a little bit of our capital and capital from family and friends, using the PE jargon. We are up and running, as a independent ship leasing company based in Hong Kong. So our business model is as a ship leasing company with our capital and also the back financing from the banks providing the senior debt. We provide solutions using finance leases and operating leases. So first and foremost, in terms of customers, it's the quality of our lessees. In terms of type of tonnages, we like to support our lessees who would invest in different type of tonnages at that particular point in time, but we definitely, will look into the fundamentals. So looking into the order book, I think throughout these conferences, people has already mentioned that, tankers, bulkers are reasonable tonnages to offer. But on a more important note, we would like to invest or we would like to provide capital to what we call future-proof tonnages. It's not only on the supply-demand fundamentals. On the ESG front, we want to make sure that, the vessels that we would support, would make the CII trajectories IMO compliant, Poseidon Principle compliant. So those are things that we will look into very seriously. As I have mentioned, in our business model, we will get a lot of support, from the senior debt banks. But I think, we will start from here, to provide, our finance lease and operating lease solutions.
Thank you very much. And just one question for you, Kenneth, there. In terms of jurisdictional focus, do you have a kind of preference, or are you fully global, or what markets interest you?
Yeah, we are based in Hong Kong because starting year 2020 we have this very robust ship leasing bill enacted and provide all the tax stability, meaning that based in Hong Kong we can do all kinds of international businesses. And so, and also we are not restricted to financing just Hong Kong flag vessels. So we are based in Hong Kong to take tax positions there, which is what's required under today's OECD environment. But really, it's all global capital and globally, we source, our the transactions from the lessees.
Perfect. Thank you very much, Kenneth. And then Ting, over to you from the kind of more traditional European bank perspective.
Yes. Good afternoon, everyone. So as a traditional European bank, SocGen is very strongly and long-term dedicated to shipping finance and the shipping industry. So we are present in all segments, container ships, dry bulkers, tankers, gas carriers, to renewable assets, renewable energy-related assets, like wind farm installation vessels, further to marine infrastructure-related assets, such as LNG bunkering vessels. And we are also now looking into the new segments, such as CO2 carriers, hydrogen carriers, etc. We have a solid client base across different in each segments, including established ship owners and operators, as well as leading financial lessors. We provide a broad range of financing solutions to our clients to meet their needs, needless to say, mortgage-backed loans, ECA-backed loans. We also provide finance leases with a key focus on French tax lease and JOCO in the region. In addition to financing, actually, what we make ourselves proudly to say, what makes us different in the market is that we do also provide a wider spectrum of advisory services to our clients, including financial advisory to raise debt, then to like corporate level, asset level, M&A type of advisory, then all the way to equity placement or also ESG advisory. So, needless to say, for the shipping industry to decarbonize, it needs all the hands on the deck. So, beyond engaging with our usual ship owner and operator community, we are also actively engaging with different stakeholders across value chain. From, for example, port authorities, port equipment suppliers, fuel suppliers, engine manufacturers, etc. So yeah, as a traditional European bank, we do believe we still have a lot to play, a very important role to accompany our clients and their partners through their energy transition journey.
Thanks, Ting. That was really useful to hear. Kenneth, just going back to you, you were talking very much about the leasing side in terms of financing structures. Is there a particular reason that you've gone down that direction as opposed to mortgage-backed?
Well, I think just mentioned, there are a lot of committed long-term players, but the funding gap, well, we don't see it really, in Asia, because it seems that people who needs capital, got lots of that. However, when the ESG requirement really comes in, when the verdict is determined on whether it is going to be methanol, ammonia, or combination of that, when people will be ordering, there would be a lot of pressure in terms of finding different capital solutions. And this funding gap vacated by the previously, a lot of European banks, doing better business there, and some is taken up by Chinese leasing companies. However, that trend of a huge requirement of capital is really coming. I think that as a leasing company, using this as a platform to bind different types, different layers, of capital together to provide solutions for the long-term dedicated player is what I want to do. And if I may also say that, even within a leasing companies, as I'm also raising capital, that could be pure equity coming in a leasing platform. But there are other people wanting to use, preference shares, wanting to use notes, convertible instrument to invest into a leasing company to provide more sustainable capital. And if I may also say, there is also a lot of RMB, onshore RMB capital readily really prepared to invest, in the shipping space. But because RMB is not internationalized yet, there are all sorts of interim solutions that we can find in Hong Kong as a leasing platform to tap those capital. So I think there's a lead, for us to find long-term sustainable capital through a leasing platform.
If I can just add on the debt side, on the question of mortgage loans versus finance leases, we do both. And interestingly enough, if you look at our portfolio, how it has developed over the last 5 years, it's roughly 50-50. It's really driven more about the specificity of the project. So there are certain projects, for example, that you cannot use a lease structure. If you think about financing a KS structure in Norway or a KG structure in Germany, it just doesn't work. And so that's one example. On the other hand, high-risk projects, very high LTVs, non-recourse projects, et cetera, those would tend to lend themselves more to finance leases versus mortgage loans.
Yeah, no, thank you for that kind of additional detail there. And certainly from our perspective, being lawyers, we get to work with a broad set of different clients. So we work with the traditional banks, we work with funds, asset managers, and certainly in the last 2-3 years, just mirroring what's been said, we see a lot of different new and nuanced structures with money coming in at the equity and debt level on projects. So it's I think it keeps it very interesting in terms of funding structures and products. Tom, moving over to you on the kind of advisory side, Transport Capital. Again, with a focus on Asia in particular, but feel free to broaden out if you want to. Can you give us an intro into the type of clients and work that you do, and give us an idea of some of the key drivers and challenges in obtaining capital for those clients, and maybe focus on some of the solutions to those challenges that you've got. And if you've got case studies, obviously the audience will be more than happy to hear.
I have 10 slides on here afterwards. I'm just joking. Thanks, Jeff. We see a lot of different clients, and I think that's the beauty of working in a firm like Transport Capital, that you come across the whole range of the industry. We deal with both on the capital provider side. We have a very, very wide range of network in both here in Asia and in Europe and in the US. Client side, we work with everything from the smaller ship owner to very sizable ship owners. Of course, they all require different solutions, and I think that's where we can add value, where we come in and give them a bigger range than they can source themselves. Of course, everyone can put aside a big team and spend money and time on sourcing, but for most companies, that is too much overhead when you maybe not financing all the time. So we sort of strategy-wise of our clients is often very different. The requirements, as I said, are different, and we're really there to connect those clients with the most appropriate capital providers and solutions. And I think in our firm, we have a very diverse background of people. I myself come from the banking side. I have some colleagues from the banking side, but also people with a very, call it, operational shipping experience, and that's extremely useful when we work with our clients to find and target their preferred capital source.
Thanks very much for that insight, Tom. And then moving on, Mark, perhaps this one's for you, and correct me if I'm wrong in the description of owner and asset manager. Perhaps if there's any nuances, please let me know. Can you give me a kind of quick overview of your business, how that operates, and I guess also a view of the current state of the market in terms of being able to access different products, different structures, and work with a different array of capital providers? Yeah,
sure. Stamford's somewhat unique in that we're a ship owner. We're also regulated by the Monetary Authority of Singapore. So that is, in an industry where the ship managers, don't tend to be regulated. That's a somewhat unusual offering. Obviously, that is something we do for the benefit of our investors. We feel that we wanted to differentiate the way that we raise third-party capital and we invest in ships. And we wanted to do that in a slightly different way maybe than we had, all of us who've been in the industry for a while have sort of seen previously, in that we wanted absolute complete transparency, found a way basically to eliminate all conflicts of interest, and indeed to voluntarily have ourselves regulated. The transparency part's very important. I think that we've all seen owners, try to attract external capital. Generally, there's fees taken out left, right, and center. Technical management's done in-house. That's worth a few $100 a day on top of it. So we contract a third-party technical management. That means that we're incentivized entirely to keep those costs down because we basically are paid through carried interest and not through fees. So that we like that nice clean model. Our investors like that quite a bit as well. There's always a question in terms of who our investors are. There's different investors in different ships. We had two main raises. The first was in the dry bulk side around 16, 17, 18, and then the second was product tankers, where we started buying ships primarily out of the Ocean Tankers bankruptcy in 22. Both of those, we've sold down quite a number of those ships. We've taken those profits over the course of the past 6-9 months. and they've done fantastically well. Combination of, I mean, you get kind of lucky sometimes. So that's sort of us in a nutshell. Also, anyone who knows Stamford Shipping will know that all of our ships are named after Chelsea players, which is not my personal policy, but that's what we do. As far as capital, we have our financing source. Our equity is a combination of Asian, European, and U.S. equity. It's family office, it's wealth managers, it's private equity. We also work in conjunction with certain industry partners. A lot of people know that Olam was one of the original anchor investors on some of our dry bulk ships, for example. We have the same on the tankers with a different party. Financing is a combination of senior debt. We did a lot of Chinese leasing on the product tankers because we just found that we kind of hit the window where the Chinese lessors were somewhat locked in their basements and much more flexible in terms of the financing that they would offer at the time. We're now working on closing a couple of Japanese lease structures where we find right now that the pricing is very advantageous and the terms are quite nice as well.
Thanks for that. And one of the points here just to touch on is cost, and cost of finance on the debt side is not something that you can just say this is how much we charge. Obviously, there's a huge variety of factors that impact that leverage, the underlying business. Do you look at the asset value alone? But one of the big misconceptions, certainly with the non-traditional providers of capital in the industry, is that the cost is very high. Now, on the Chinese leasing side, I feel there's a lot of clarity about pricing now, or certainly a lot more clarity in the last 5 years. Where are you on that curve in terms of the non-traditional finance providers? And can you give the audience some indication of what it looks like?
Well, I would just generally say that sometimes the leasing structures can be advantageous as far as, well, particularly in the pricing side. Frankly, the Chinese leasing that we did was at fixed rate right at the time when the underlying rates started moving, and we kind of got a bit lucky on that window, so that by the time we actually drawn down, the effective margin was heavily compressed. So that worked nicely. We are also finding, that out of Japan, because of the JOLCO structures, are more difficult to execute, that a lot of the there's a greater interest now in sort of traditional leasing activities from there, and again, we do find that that's advantageous as far as price. And as we all know, when the bank debt generally has had margins compressed as well. So so I guess effective all-in pricing maybe hasn't moved that much because the underlying rates have come up, but the margins have been pressed down. I will make one general comment, which is something I like to rant on about at the office, is that people kind of complain about the interest rates these days and all this kind of stuff. And anyone who's been in the industry for a while, like when I started, it was 20% LIBOR. It was like that was super difficult to anyone to make money in that kind of environment. So I would sort of counsel not to get overly swept up into about a 5% interest rate environment.
We've had a decade of being spoiled by cheap debt. Elias, have you got any comments on this one?
Look, with the debt provider hat on the Australis side, what we'll say is quite clearly the rise in interest rates and base rates obviously has been great for us, for sure, because on a relative basis, it's made us a lot more competitive vis-a-vis the bank. Remember, our capital comes from large institutions. The return is absolute returns, and so those don't move with the base rates. And suddenly the delta vis-a-vis the banks is today actually quite small. And if you take into account the extra flexibility you get into the structures in terms of perhaps the higher LTV, the non-recourse nature, the longer armored profiles, et cetera, it's actually driven a lot more business towards our part of the world.
Thanks for that. And Tom, any particular input on this point? What do you see in the market? You work with a broader range.
Yeah, no, clearly the pricing will differ a lot, but I agree. the alternative capital providers have effectively become more cost effective, so to say. At the same time, we do also see now where the banks are a little bit back, and that is partly because particularly the banks with balance sheets and with full scale operations, they take deposits, and that helps their net interest income. And of course, shipping companies these days, they actually carry quite a lot of cash on their balance sheets. But really, I think what we see is that if you're a stronger credit and if you have a good project, you can get higher leverage and quite decent pricing on that. And I think that has moved a bit, and clearly there are competition among the Chinese lessors, and we heard on the earlier panel, there are much more of them. They are now coming in doing different structures, like more operating leases. Some are taking effectively bigger market risks on their projects. So there is sort of a good development, I would call it, in terms of what's available, and even though we are in a high interest rate environment.
Great, perfect. And then, unless there's any other particular, anyone else wants to comment on this?
Yes, yeah, I just wanted to add something, well, not to defend commercial banks, but
sure.
I just would like to say that, I think, back to Ship Finance 101, I was told that the key factors affecting terms of a shipping loan used to be 3 C's, right? Collateral, as we mentioned, asset value, then cash flow, the strength of the contract, and corporate strength of the balance sheet of the sponsor. And of course, nowadays, a 4th C adding to the equation, which is climate, as was elaborately, extensively by the previous panel. So I would just like to say the high interest rate environment is just one factor. And for humble senior lender like us, we take into the 4 C's into consideration our lending consideration.
I just want to add quickly that it is a very transparent, competitive world. So whatever one pricing, how many products combined together, each source of capital has their required return, and ultimately the receiver of the capital will know what kind of cost they pay, whether it's fixed rate, whether it's floating rate, all can broken down. It's a very, very transparent world. And like what Ting said, it all has to do with the risk, with that project as well. And right now also the market is quite receptive to the, even in the leasing product, the lessee are quite receptive to a floating rate. So everything is really, really transparent. And we really go down to the basic of what kind of risk we take and what kind of return we get.
Yeah, no, agreed. Risk reward, product structures, and a wide variety of options that are available is always useful for the industry. And that kind of takes us to the next question. And maybe Ting, I'll also kind of direct this one at you. Taking into account where current asset values are, can you give me an indication of kind of leverage and LTV options that you can either offer or, Tom, later for you, want or need on your clients' behalves, and kind of how this interplays with other key levers, cost of finance, etc.?
I would say for typical senior term loan for shipping, we would look at LTV between 70 to 75% of a contract price for a new building, or of the fair market value for second-hand ships. Of course, depending on other parameters, like I just mentioned, the 4 C's, the terms and the LTV could be variable for different sponsors, different projects. So it's transparent, as Kenneth mentioned.
Is that impacted by asset prices? So we're in a high market. Does that impact LTV for your bank?
Yes, that's one consideration into the whole lending process. Say a container ship which was ordered at a contract price of over 150 million. And when it's get delivered, maybe the market has already seen a huge correction, and at that time, the asset value might have been impacted negatively. So when we structure the LTV of the transaction, we would take into account both the contract price and the projected market value into the whole package. So, I don't know, it may be a bit generic, but I don't know if I answer your question.
No, useful, thanks. And then Tom, I'll quickly pass this over to you. We've got 3 minutes, so this is probably our last question. So Tom, if you take it first, and if anyone else wants to comment, then please add after Tom.
Yeah, I think we see the whole range. We've seen projects over the last couple of weeks which are done at 90% LTV for new buildings. We clearly there are some lessors are taking and other capital sources as well. I mean, they are taking a risk approach to that and sort of try to de-risk, particularly if there is good cash flow from a contract. I mean, you want to try to de-risk a bit that in the first few years. At the same time, we do see also banks and lessors are willing to stretch repayment profiles because they also know that we won't have strong markets forever, so we need to bring down the break-even levels. And of course, it all matters how strong the backing credit is. Anyway, for a project financing non-recourse, you need to structure that more conservative. But yeah, we see the whole range. We see even Japanese doing close to 100% for call it middle-aged ships, but with very strong credits.
No, I just want to add that it's really difficult to overgeneralize. If we remember, the 100% financing of a Cape in 2007 is probably a 50% financing, of a Cape in 2007 is probably 110% financing, a few years later, right? So I think at different point in the market for different type of tonnages, there are different ways, to make things make sense. For example, right now, second-hand prices is probably quite robust comparing to the freights that they are getting at the moment. Just very quickly, just in the last since we started in the last 6 months, for the deals that we write and for the deals that we're bidding, there are LTVs, from together with senior bank debts, there are LTVs from 50% to 90%. Different type of tonnages. So I think it's difficult to overgeneralize, and thank God, this is the case because our expertise can be used, in packaging things together.
Just to add one thing, and I think these questions are very good and sometimes are best answered using examples, so real-time examples. So take the tanker market, obviously, which is super, super hot and has done so well over the last couple of years. Q1 of 22, we're financing 75 to 80% LTV, non-recourse on a spot basis. Today, to get to the same 75 or 80% LTV, we will require a time charter of 3 years plus. We can also do spot, but that's going to be 40 to 50% LTV. So that gives you a sense of what has happened and how asset values reflect the financing structures.
That's great. I think that answers the question very well. Thank you. I think we've run out of time, so I just want to say thank you very much. It's been a really interesting, lively discussion, so thank you. Thank you, everyone.